Okay, so now we're into Chapter 18, the second half of the course, where we really kind of move in a different direction. And in this chapter, we'll introduce two things that we haven't talked about yet. We'll introduce managerial accounting, and we'll introduce manufacturing, which we haven't done yet. So the first thing we want to talk about is the difference between financial and managerial. And so far, everything we've talked about in Accounting 1 and so far in Accounting 2 has been financial accounting. And the users of financial accounting are all outside users. And therefore, the purpose of financial accounting is to help outsiders make decisions. So, to help that investor decide if he wants to buy our stock, to help the bank decide if they want to make us a loan or not. So it's all aimed at outsiders and helping them. The time period that we deal with in financial is always the past. I don't know why this thing does that. Is always the past. So for the year ended whatever, what happened in the past year or the past quarter, we're always reporting on what has already happened. The rules for financial accounting are GAAP, generally accepted accounting principles. They tell us pretty much everything that we have to do, and so we follow. It's all about following the rules there. The scope of what we report on in financial accounting, we report on the whole company, the company as a whole, so the total revenues, the total expenses, the total assets. And the reports are done annually or sometimes quarterly, but again, it'll be told to you through GAAP or through the IRS in a lot of cases. A company of this size has to do it quarterly, or you have to do it annually. And there's one more thing I'm going to talk about here, which will be behavioral implications. And there's really none with financial outside of if you don't do this right, you could go to jail for tax fraud kind of a thing. But managerial is different in all of these things. So the users of managerial accounting information are internal. And again, keep in mind that accounting is an information system. So we're talking about a different system now for a different group of users. These will be internal, and the purpose is to help managers. Again, accountants are pretty clever with their names, so it's managerial accounting because it's for managers to plan and control. And if you've had another business course, probably talk about the functions of management. Planning being the first one and controlling generally the last one. Controlling doesn't necessarily mean controlling people. Controlling means I set some plans, I set some objectives, and then I go back later and I see if I met those. That's what the control function is to go back and look at your goals or your objectives and see if you met them and determine why or not, why not. So it's the follow-up. It's what did I come in within budget? Did I meet my sales goal? So that's the controlling function, and that's what we're doing here. As a result, this is all future-oriented. We'll deal with a lot of forecasts, what we think is going to happen. We'll base it on information of what's happened in the past, but for the most part, this is for planning purposes, so I need to predict what's going to happen in the future. The rules, there are no rules for this. There's not one right way to do this because different managers need different information, different companies do something different. So since this is all internal, there's no laws or rules that you have to follow, and like I said, there's not one right way to do it. We're going to be reporting on segments of the business as opposed to the business as a whole. For instance, the production manager might not care about the same things that the purchasing manager does or the HR manager does. And so if I'm the production manager, I don't care about the expenses or revenues for the entire company. I just want to see the things that affect my portion of what I'm responsible for. And also, these will be done weekly or daily, sometimes monthly, but if I'm planning my staffing decisions, I can't wait till the end of the year and figure out what happened, right? I need projections, and I probably need them, maybe even daily to do this. So I can't wait. That's why it's future oriented, and again, there's not one right way. So in financial accounting, if you don't follow the rules, again, you could be in legal trouble. Again, since it's for outside users, it all has to be done exactly the same way so that an investor can compare two companies and know that he's looking at the same thing. That's why, and so that the IRS is treating everybody the same. Because they're outside users, there needs to be this consistency. But here, because they're internal users, you can customize the information for each individual user. So there's not one right way. The cost of not doing it right, nobody's going to come in and check you to see if you're doing it right. It's just if you're not doing it right, then you're not making smart decisions, and you probably won't be in business that long. The behavioral implications, though, we will have some significant behavioral implications on employees. Staffing decisions, and if you're if a supervisor of a department is paid incentives for coming in under budget, they're going to be doing things to make sure they come in under budget. Like I said, especially if people's pay is related to this. And so, as we go through the second half of the course, I think you'll see a lot of areas there where how we use this information and what information we use will definitely affect people's behavior in our company. So there's no set rules that we have to follow, but we do have ethical standards. These are set by the Institute of Management Accountants, so that's an organization. They have an accountability. So nobody's going to come and check and see if you're doing this right, but we have an accountability to all of the stakeholders of this business. So decisions are going to be made on this information on a daily basis. So this is going to affect our customers, our employees, our owners or our stockholders, our suppliers. So all of these people are going to be affected this. So they're all going to be holding you accountable, and you do have the obligation. The ethical standards outline 4 areas that you have to be. So it's competence, so making sure that you are qualified, that you have professional expertise, that you admit if you don't know how to do something. Confidentiality, integrity, and oh shoot, what was the last one? Gosh, I can't remember what the last one was. Integrity, competence, confidentiality. Where is it? Integrity. Oh, credibility. There you go. So that you communicate things fairly, you avoid conflict of interest, you are objective when you report this information. And it sounds, that should be obvious, but sometimes the information shows that it's your best friend's department, that there should be budget cuts, or not budget cuts, but, it's less efficient, and, or, that they should be looking for another supplier, and the current supplier happens to be your golfing buddy. So there's a lot of things like that. And again, nobody's checking up on this stuff, really. So it's ethical standards are more important here. Some trends in accounting and managerial accounting specifically, we have more and more of a shift to service organizations, which are harder to track. It's harder to track efficiency and productivity in a service business, so we're constantly looking for ways to find more, or to be more efficient there and collect our data in a better way. There's more and more global competition, which again forces us to be more and more efficient. Time-based competition, which means you have to just really streamline your process and be as efficient as possible, because if you can't deliver on time, somebody else will. If you don't have what your customer needs, they'll go somewhere else. Nobody's really willing to wait anymore because there's so many efficient things. And so we see things like just-in-time inventory, total quality management, enterprise resource planning, where I'm trying to connect all these separate parts into one comprehensive thing, which is expensive and time consuming to implement, but once it's implemented, it's really going to improve efficiencies. So that's kind of an overview of managerial accounting and the direction we're heading there. We have talked about service and merchandising businesses, and we have not yet talked about manufacturing business. So a service business is anything that sells time, knowledge, or skills. So hairdressers, professional services like accountants or lawyers, car repair, a school, any of those types of things are service businesses. A merchandiser is someone who resells products that they purchased. And a manufacturing a manufacturing business, which is what we're going to introduce here, is somebody that converts inputs into products. So a merchandiser is any kind of retailer, Target, Kohl's, a grocery store, Walmart, a bookstore, anything like that. They purchase something that's already made, and then they resell it. So they didn't make it, they're just reselling it. A wholesaler also falls under this category. They're kind of the middleman generally between the producer and the retailer. A manufacturer is the producer. They take any kind of inputs and turn them into a product. So a car manufacturer, a farmer. Some people consider restaurants to be this. They take raw ingredients and sell it. Some people put restaurants into services. But so the first two we've talked about. The third one we're going to introduce in this chapter. This should be familiar territory here. We started out with service companies, and we said the income statement was pretty simple. We had revenue minus expenses equals operating income, and we had our assets, our liabilities, and our owner's equity on the balance sheet. And the assets were pretty short and sweet here. We didn't have inventories. We just kind of had supplies and that sort of thing. So it was pretty basic. It's important for any business, and really at the heart of this managerial accounting is understanding what it costs you to do whatever it is you do. And so that's really critical to this one, and it's simplest at a service business. So for this one, Knotts and Reynolds hair cutting service. Where am I here? So we've got a service business here. They cut hair. They provided haircuts for 240 clients and earned revenue of $4,900. And here were their operating costs. So what is the cost to provide one haircut? And so really we just take our total operating costs. Again, this is out of the demo problems if you'd like to do them there. Divided by the output, or in this case, the number of haircuts. So in this case, I add up my total operating costs here are $1,896. And that's how much it cost me to provide 240 haircuts. So my total cost is $7.90 is the cost per haircut. And that will be the basis for all of my decisions, especially my pricing decisions. So it'll get a little bit more complicated with different types of services, but really we have the same thing. And this is just really this cost to provide one unit of service is critical knowledge for any type of business in here. So then that moves us up to merchandising. We talked about them. Again, we add this asset here called merchandise inventory, and our income statement gets a little bit more complicated here when we say sales minus cost of goods sold equals gross profit, and then we subtract off our selling and admin, and that gives us the operating. And cost of goods sold here is measured as the change in inventory. Now this is just a variation on what we did in the at the end of chapter 16. We looked at a lot of these things where we said the beginning balance plus what we added in minus what we took out equals our ending balance. And so in this case, that's what we have here. The beginning inventory plus what we added in is our purchases, minus what went out is what was sold, equals the ending balance. And so in most of these cases, we have the beginning, we have the ending, and we have what went in, and we are trying to figure out what went out. And so we could just kind of rewrite that in the beginning plus the purchases minus the ending equals cost of goods sold, or what went out. We're going to use this a lot in this chapter, this basic formula, and change it for different inventories, but it's the same thing. The other way to look at that, again, you could look at it as a variation of this theory, of this formula, but you could also say the beginning plus the purchases is what was here during the month. And this is what's still here. The ending is what's still here. So if it was here, and it's not here anymore, we sold it, is basically what this formula is telling you. Here's what we had, here's what's still left. The difference must be what we sold, what went out. So in this one, we are going to figure out cost of goods sold for a merchandiser. And again, we take this basic formula, except instead of a horizontal like an equation, we're going to put it up and down. So we take the beginning inventory, the beginning merchandise inventory, which was 8,200, and then we're going to add in, or we're going to, plus our purchases, so that will give us what's available. So beginning inventory is 8,200 plus our purchases were, that's this guy, 40,000. And we include the freight. If you remember from back in accounting 1, we added those freight costs, those shipping costs into the merchandise inventory. So we're kind of putting these two together. So the purchases plus the freight it costs to get here gives us 42,700. So that's the beginning plus what went in. Gives us those two together. It's 50,900. Gives us what we call goods available for sale. So what we started with plus what we put in this month. That's how much was here. At the end of the month, ending inventory was 5,100. So that's how much was still here. So what was here minus what's still sitting here, that difference, 45,800, gives us cost of goods sold. That's what went out, what we sold. So it's just a variation of it, but you're going to see the same thing repeated over and over. The beginning plus what went in is what's available, minus what's still here tells us what went out. And in this case, what went out is what we call cost of goods sold. If it's not here anymore, it's because we sold it. Well, hopefully that's what it is. Okay, so that takes us to manufacturing income statements. So we have three, instead of just one merchandise inventory, with three types of inventory. And, again, the names are pretty self-explanatory, and I think you can kind of, even if you haven't worked in manufacturing, which most of us haven't, but you can kind of picture the flow of the inventory going through here. So raw materials those are the ingredients that we bought that we haven't used yet. So the wood or the fabric or the metal or whatever, just raw materials sitting there we haven't got in. Work in process, that's stuff we're working on that we haven't finished yet. And then finished goods is the stuff that we've made, but we haven't sold it yet. So it's sitting in a warehouse ready to go. So for a manufacturing company, you can see this looks a lot like a merchandiser. Sales minus cost of goods sold equals gross profit minus selling and admin equals operating. But instead of just merchandise inventory, what cost of goods sold measures is the change in this finished goods inventory, right? what was sitting in the warehouse ready to sell, plus what we manufactured this month, minus what's still here is what we sold. However, this number right here, cost of goods manufactured, gets a little bit more complicated. Sometimes we have to do a couple steps before we can get to that one. So we're going to talk about those types of steps and kind of how we follow this through. But I want to talk about the different types of costs a little bit first, and then we'll kind of get back to this guy and how we get this cost of goods manufactured number. So the types of costs, there's different classifications. One of the main ones being direct versus indirect cost. Direct costs are things that can be directly traced to a product that I manufactured. And I can tell you exactly how many. So direct materials, which I will pretty much always just write DM, and direct labor, DL. Those are your direct products. I can tell you exactly how much time somebody spent making this chair. I can tell you exactly how much wood went into this chair, or metal, or whatever I'm making. Indirect material, or indirect costs would be indirect materials and indirect labor. These are costs that are necessary for the manufacturing process, but not traced directly to a chair. So, for example, indirect labor, a good example of that is a production supervisor. He's responsible for all of the production, but I can't say he spent 12 minutes supervising this chair and the production of this chair, and he spent 7 minutes supervising. We don't, it doesn't do it that way. And so it's necessary. So what we're going to do is we're going to lump these indirect things and a couple other things into what we call manufacturing overhead. And that's going to be kind of a key thing. So these guys go in here along with a couple other things. Indirect material are things, it might be things like anything manufacturer related, but I don't trace it directly to the product. Sometimes it's because it's not in production, like oil for the machinery that I work on or something like that. Sometimes it is part of the product, like glue is almost always a good example of that, but it's not, I don't track exactly how much glue I did. So let's say I'm working, I don't track like how many staples I used or how many inches of tape I used on a particular job, because they're so small and they're such an insignificant part of the final product that even if I could trace exactly how many, parts of an ounce of glue I used in this, it wouldn't be worth it to track it. So those aren't traced directly to a product. I just kind of take the total and spread it across, which is actually what we'll be doing in the next chapter. But so think of direct materials as the main product. There are things that could be a direct material for some products and indirect, like paint. If it's a significant part of the product, it might be direct for this company, whereas somebody else calls that indirect because it's a very small part. So direct materials and direct labor are what we call prime costs. And direct labor and manufacturing overhead, I don't really think I need that arrow right there, because that's not really pointing to anything, are what we call conversion costs. These are the things that are used to convert the direct materials into a product. So direct labor, for example, is a direct cost, it's a prime cost, and it's a conversion cost. It's also what we call a product cost. So product costs are anything that are related to manufacturing. That includes direct and indirect costs. And period costs are associated with a period of time, not related to production. So anything related to manufacturing, to the plant, to the anything production related or manufacturing related is a product cost. Period costs are what we call selling and administrative. So those will be marketing costs, shipping things, the CEO, those types of things that are not directly related to manufacturing. And there's some more problems in the practice problems and in the homework where you classify the costs to make sure you got that. This one shows you some examples. So you can see depreciation on the manufacturing equipment is part of manufacturing overhead. But depreciation on the office equipment, so that's a product cost. Depreciation on the office equipment, though, is selling and administrative, because this is office and this is manufacturing. Same thing here. This is on the factory, so it goes into overhead. This is on the office, so it goes into selling and admin. So the product costs, the direct material, direct labor, and manufacturing overhead. Period costs are all the other stuff, the non-manufacturing related. So here's a problem. Where we are going to, they want us to calculate the total manufacturing overhead. So manufacturing overhead it includes indirect labor, indirect materials, and some other manufacturing overhead costs. It does not include direct material or direct labor, because those are product costs, but those are not manufacturing overhead. And it also does not include any selling and admin. So glue for the frames, again, this is in the demo problems. Glue for the frames should be indirect material. This is a manufacturer of sunglasses. So that will be part of manufacturing overhead. Depreciation on the company cars used by the sales force, that'll be selling and admin. So that is not part of overhead. The plant depreciation that goes into what we call other manufacturing overhead. Interest expense is not. That will go under selling and admin. The lenses will not. They'll be part of direct material, so they'll be a product cost, but not part of overhead. The company president's salary, that'll be selling and admin, so I don't want that one. The plant foreman's salary, though, that'll be part of indirect labor. So that will be part of manufacturing overhead. The plant janitor's wages will again be part of indirect labor. That's manufacturing related. And oil for the manufacturing equipment, since it's manufacturing, that'll be indirect materials. So we'll include that. So we add up those 1, 2, 3, 4, 5, and we get total manufacturing overhead of $10,450. So that's a little practice into what's part of overhead and what's not. Now let's go back and talk just a little bit about those 3 types of inventories that we saw on that balance sheet. So we have raw materials, we have work in process, and finished goods. Again, fairly self-explanatory. You can kind of picture these moving through here. Picture a closet here. These will be the things that we bought that we haven't started to use yet. This will include direct and indirect materials. And then, so the purchasing guy is in charge of those. Then here's the production guy. So think of this as actually the manufacturing floor, or the actual, plant process, whatever they're working on. And so the production guy sends a requisition and says, hey, I need 100 more pounds of wood, or whatever they're doing. And so it moves over here into work in process. And so this requisition, this form, would actually stimulate a journal entry that would credit raw materials inventory and debit work in process. So as the product physically moves from here to here, we move it in our journal entry as well. And so this is the stuff that's actually being worked on. These are your product costs. So we do direct material used, direct labor, and I add in my manufacturing overhead. So I keep track of how much material went into it, how much labor, how much time was spent into it, and then I'll add in the manufacturing overhead, which is really more about what I talk about in Chapter 19. And then once it's finished, once we're done manufacturing it and it's done off the assembly line, it goes over here to the finished goods inventory. And think of that as just the warehouse where it's sitting there waiting to get sold. And then once it's sold, it goes out of finished goods, and that's when we count it as cost of goods sold. Now, this is out of your book, and this is a really good. I really like this example. This change in finished goods, beginning plus what went in minus what's still here, is what went out. Okay, that is what we put on our income statement. the cost of goods sold. But before I can figure that out, I need this number right here, cost of goods manufactured. So cost of goods manufactured is what went out of work in process inventory. So out of finished goods for the cost of goods sold, cost of goods manufactured tells you what went out of work in process, what got finished and sent over to the warehouse to finished goods. And so we look at what we started with in process plus what we added in. These three things right here are what went in to work in process, minus what's still in process, what we're working on, we haven't finished yet. So what went into what we started with plus what went in minus what's left in work in process tells us the cost of goods manufactured. That's what we finished this month. Some of what we finished started last month, some of it was started and finished this month, and then we subtract off the stuff that we started this month but we haven't finished. But before I can figure that, I have to use direct materials used, and that comes from looking at what went on in raw materials inventory. So we start with raw materials plus what went in, what I purchased, minus what's still there, tells me what went out of raw materials. And if it went out of raw materials, that means it went into work in process. So what went out here went into work in process. What went out of work in process went to finished goods. What went out of finished goods got sold. Okay, so that's the flow, but you can see the process is the same every single time. What you started with plus what you put in minus what's still there is what went out. And so in each one of these, I'm figuring out what went out of each of those inventory groups. So, let me go back here. So this is step one to figure out what went out of raw materials. This is step two, and then this is step 3. So I'll call this one kind of step 1.5, which I'll change on that slide in a second. So step 1, I calculate the cost of direct materials used. The process is the same, so it's not super hard. Just keep the vocabulary straight in your head, because sometimes we're jumping in at step 2 or step 3, and they've already done part of this for you, and so you don't want to have to calculate more than you think. So step 1, calculate direct materials used. This tells us what we're looking at is the change in raw materials inventory, or what we're looking for is here is what went out of raw materials and into work in process. That's what this number tells me. The cost of direct materials used tells me what went out of raw materials into work in process. I can't just measure purchases, because again, some of the stuff that I pulled in was stuff that I bought in a previous time frame, so I can't just look at purchases. So I just look at the beginning raw materials inventory balance, what was in there at the beginning of the month, plus net purchases. So that will include freight or shipping charges. Those two things together will give me materials available for use, minus what's still there at the end of the month. So the ending raw materials gives me direct materials used, which again means I took it out of raw materials and sent it into work in process. So let's just do one of those real quick. We see a bunch of costs here, and what you can see is, okay, I'm trying to measure out what happened in raw materials because I want to calculate direct materials used. I do not need property taxes. That's the red herring that we don't need in here. So the beginning balance in raw materials is 3,700 plus what went in. So we've got purchases going in of 6,600. We've got freight charges that we had to pay to get it here, so that's 500. So those two together are 7,100 is my net purchases. So I'm sorry, material of it. Oops, sorry, wrong button. So materials available for use is what we started with plus what we added in this month. So there was a total of $10,800 worth of stuff there at some point during the month. I subtract off what's still sitting there, ending raw materials, which is 1,300. So what was here minus what's still here tells me what went out. So that is my direct materials used. That's what went out of raw materials over into work in process. So step, I'm going to change this here. Step 1.5. Sometimes you have to figure out this one separately. Sometimes they just lump it in together. So I'll just show you. So this is really part of step 2. Here we'll write that. Part of step 2. And when I say that, I mean on this one right here. So a part of this one. So that it's really just looking at these three right here. So I take my direct materials used, which is what I just calculated in step 1, and I add in my direct labor, and I add in my manufacturing overhead, and that gives me total manufacturing costs incurred. Once I have that, then I can finish step 2 here. Sorry, we'll make that step 2. And I get cost of goods manufactured. Which is what went out of work in process. What this is telling you is what went out of work in process. And if it went out of work in process, that means it went in to finished goods. So this is what I finished this month and sent over to the warehouse ready to be sold. So I take my beginning work in process inventory plus my manufacturing costs incurred, which is what I figured out there in step 1.5. So that is your direct material used plus direct labor plus manufacturing overhead. And then that will give me what I call, instead of available, they call it total manufacturing costs to account for. But that's like the available. So that's what was here in process at some point during the month. What I started with plus what I put into process this month gives me that, minus my ending work in process, what's still in process, what I'm still working on, that gives me cost of goods manufactured. That's again what went out of work in process into finished goods. And then step 3 is really cost of goods sold, which takes your beginning finished goods plus cost of goods manufactured that I just did here, right? That's this guy. Equals goods available for sale minus what's still here, ending finished goods, equals cost of goods sold. That's what went out of finished goods. So same thing, I'm always doing what I started with plus what I put in minus what's still here is what went out. So this last one here, I think this is my last one. Yeah, last one here. Sorry, this is taking a little bit longer. But this one asks us to calculate cost of goods manufactured, which means when I'm looking at change in raw materials. Here they've already got, stop that, direct materials used, right? Oops, I think I must have turned the pen off. All right. So that means they've already done step 1 for me. Okay, that part's already done. So I'm jumping in at step 2. Cost of goods manufactured. That was our step 2. So I'm going to take the beginning work in process, which was 7,000. I'm going to take, what did I add in? So they don't have manufacturing costs incurred, so I can figure that out though, because I need this one, I need direct labor, and I need manufacturing overhead. So plus direct materials used were 12,000, plus direct labor, which is 13,000, plus manufacturing overhead is 22,000. So I put those 3 together, right? And they are 4,700, or sorry, 47,000. Oh, sorry, let me let's take you off, and let's take you off. I'm trying to make it look like it will in MyLab for you. And so I get 47,000, which is total manufacturing costs incurred. Add those two together, the 47,000 that I added in plus the 7,000 I started with, and 54,000 is what I call total manufacturing cost to account for. Sorry, I'm running out of room. Minus what's still in process at the end of the month, so what I'm still working on, which is, so I use this one, now that's that one, 5,000. And that gives me 49,000 is my cost of goods manufactured. Now, because I have the beginning and ending balance in finished goods, I could go ahead and do step 3 too, even though it doesn't ask me for that. So I take my beginning finished goods, which is 19,000, plus what I added in. That's cost of goods manufactured, which I just did right here, right? So that'll come up here. So 49,000 is what I added into the warehouse. So at some point during the month, I had $68,000 worth of stuff sitting there. So that is what we call goods available for sale, minus what's still sitting there. So ending finished goods, which is 15,000, gives me 47,000 would be my cost of goods sold. So that's step 2 and 3 all together, so you can kind of see how one flows into the other. Okay, there you go. There's chapter 18.